Let me start with a question. Why is it that some Canadians, often with the same income, same investments, and same market returns, end up with far more wealth after tax than others? It's not luck. It's not even how well they invest. It's about how they structure what they already have. I see it every day. Two households earning similar six-figure incomes, saving diligently for decades, yet one family retires with complete financial control while the other quietly loses tens of thousands of dollars to unnecessary tax every single year. The difference? The first family is structured like the wealthy. They've learned that wealth isn't built in the markets. It's built in the margins, in how you hold your investments, how you withdraw income, and how you transfer what you've built to the next generation. Because here's the reality. The tax strategies used by high net worth Canadians aren't secret. They're not locked behind complicated loopholes or offshore accounts. They're built on the same tax rules available to everyone, just applied intentionally. So if you have ever thought those strategies are only for the ultra rich, here's the truth. They're not. They're for anyone who wants to structure their wealth in a smart way before the CRA does it for them. And that's exactly what I want to show you today. Hi, I'm Tanya Solsla, Investment Advisor at CG Wealth Management. I work with successful Canadians, entrepreneurs, professionals, and families who want to protect what they've built and make sure their wealth lasts through their retirement and beyond. And one of the biggest differences I see between the average investor and the affluent is simple. The wealthy don't just invest differently, they structure differently. They understand that where you hold your money matters just as how you invest it. So in today's video, I'll walk you through the same tax frameworks that high net worth families rely on and show you how to apply those principles no matter where you're starting from. Because once you understand how to structure your income, investments, and estate properly, you can dramatically reduce taxes and create a more stable, predictable path to long-term wealth. If you find this valuable, don't forget to like, comment, and subscribe. And if you'd like a personalized second opinion on your structure to make sure your wealth is working as efficiently as possible, book a time with me using the link in the description below. Number 1, the core principle. Separate growth from income. The foundation of this entire strategy is simple. Separate your growth assets from your taxable income. The wealthy rarely hold large investment portfolios personally. Instead, they use structures that let their money grow tax-deferred or tax-free, keeping more of each dollar compounding. Think of it this way. When you invest personally, every bit of interest, dividends, or capital gains can be taxed annually. That's like running a marathon but stopping every mile to pay a toll. But when you grow money inside a structure, whether it's a corporation, a trust, RRSP, or TFSA, you delay that toll. Your capital compounds uninterrupted, and over decades, that creates an enormous advantage. The strategy isn't about avoiding tax. It's about controlling when it's paid. And timing, for wealthy, is everything. Number 2, the everyday foundation. RRSPs and TFSAs working together. Before we get into complex structures, let's start with the basics, because even millionaires start here. RRSPs and TFSAs are two of the most powerful tax tools available to any Canadian. The wealthy simply use them more intentionally. Take the RRSP. If you're in a 48% tax bracket in Ontario, every $10,000 contribution can save you roughly $4,800 in tax today. That refund isn't free money, it's deferred tax. But when managed properly, you can withdraw that same $10,000 in retirement at, say, a 25% tax rate, effectively saving $2,300 per contribution. Now layer in TFSAs. While RRSPs can defer tax, the TFSAs eliminate it. Growth, income, and withdrawals are all tax-free. So wealthy investors typically position high growth, long-term investments inside their TFSAs because every dollar of growth stays theirs forever. Smart planners then coordinate these two accounts. They'll withdraw from RRSPs moderately. They'll withdraw from RRSPs in moderate income years to refill TFSAs, smooth income in retirement, and minimize clawbacks on OAS. You can do the same thing by treating your registered accounts not only as silos, but as parts of one lifetime strategy. Number 3, the business owners. Advantage? Holding companies. Now let's look at the structure that truly amplifies this approach for entrepreneurs and incorporated professionals, the holding company. If you own an incorporated business, you already have a built-in tax advantage. Corporate income under the small business limit is often taxed at roughly 12 to 15%, depending on your province. Compare that to 45 to 53% of top personal tax rates. So instead of paying yourself the entire profit each year and triggering personal tax, many business owners retain some of those earnings in their company, investing them inside a corporate investment account. Here's what that does. It keeps more capital compounding because you're investing pre-tax dollars. It allows control over when you pay personal tax, since you can time dividends strategically. It opens opportunities for estate and insurance planning that can later remove retained earnings with minimal tax. For example, a business owner earning $500,000 a year annually might only pay themselves $200,000 personally and leave $300,000 in the corporation. That means $300,000 gets taxed at 12% and continues to grow inside the company. If invested prudently, the long-term compounding on that after-tax capital is massive. It's the same logic that powers RRSPs, but with corporate scale. Number 4, the family advantage, income splitting and trusts. Another cornerstone of the high net worth strategy is income splitting, spreading income across multiple family members who are in lower tax brackets. This is often done through a family trust, but there are simpler versions too. Let's start with the trust. A family trust can own investments, company shares, or real estate. It can then allocate income to beneficiaries, often adult children or a spouse, who have lower income and thus pay far less tax. For example, instead of one person earning $200,000 and paying top tax rates, a family trust might distribute $40,000 to 5 beneficiaries. That same $200,000 could now be taxed at much lower average rates, legally and efficiently. Even without a trust, you can apply the same principle. Use spousal RRSPs to balance retirement income between spouses. Allocate non-registered investments to the lower income spouse. Pay a reasonable salary to family members working in the business. When structured properly, this spreads income across the household, reducing your collective tax burden. And again, this isn't just for the wealthy, it's for any family willing to plan intentionally. Number 5, the legacy advantage. Tax deferral compounds like growth. We talk a lot about investment compounding, but few people realize that tax deferral itself compounds too. Every dollar you don't pay in tax this year can stay invested, earning returns year after year. And when you repeat that cycle for decades, the difference is staggering. Let's take a simple example. Imagine 2 investors, Emma and Dave. Both earn around 6% annual return for 30 years. Emma invests personally and pays 25% tax on her returns each year. Dave invests inside a structure that defers tax until the end. After 30 years, Emma has about $340,000. David, who deferred tax until the end, has over $430,000, nearly $90,000 more, simply because his growth wasn't interrupted by annual tax payments. That's the compounding power of deferral, and that's what high net worth Canadians optimize, whether it's inside a corporation, trust, or registered plan. Number 6, the estate planning layer. Transferring wealth efficiently. The truly wealthy don't just plan for growth, they plan for the transfer. Because without structure, your estate could face a surprise 40 to 50% tax bill when you pass away. Every RRSP or RIF dollar is deemed withdrawn at death. So a $1 million RIF could create a $450,000 tax liability overnight. High net worth families mitigate this in several ways. They melt down RRSPs strategically during retirement. They use permanent life insurance to pay estate taxes or create a tax-free wealth transfer. They make charitable gifts through their estate to create large tax credits. And they coordinate ownership so assets pass efficiently to a spouse or through trusts. These strategies aren't about complexity for complexity's sake. They're about clarity, ensuring that decades of hard work doesn't end up funding the CRA more than your own family. Here's the key takeaway. You don't need a 7-figure portfolio to think like the wealthy. You just need to start structuring intentionally. Step 1, max out your RRSP contributions when your income is high. Step 2, use your TFSA every year for long-term, high-growth investments. Step 3, plan your withdrawals to manage tax brackets in retirement. Step 4, create accounts with your spouse to balance income. Step 5, if you're incorporated, retain some earnings and invest them tax efficiently. Step 6, review your estate plan early, not later. Each of these steps adds a layer of control, and control is the difference between hoping you've done enough and knowing you have. Because even if you've never built millions in your net worth, the principles that protect the wealthy, tax efficiency, deferral, structure, can protect you too. Most Canadians think the wealthy have access to special tax rules. They don't. They simply take advantage of the same ones that everybody else overlooks. They plan early, they coordinate accounts, and they let structure, not luck, build their wealth. That's the real secret. Because financial success isn't just about making money. It's about keeping it, protecting it, and passing it on efficiently. So don't wait to have millions before you start planning like you do. The earlier you align your income, investments, and estate under one coordinated strategy, the sooner you'll feel the confidence that comes from true financial control. If you want a second opinion on your plan, or you're wondering whether your structure is truly tax efficient, book a time with me using the link in the description below. Because the same strategies that protect the wealthy can absolutely work for you when they're structured properly.